All right. Hello, everyone, and welcome to FCI Live. We are in week 2 of FCI Live, and this is the role of a loan in your capital stack. I'm really pleased to be joined today by Mark Fick and Roderick McCulloch from Shared Capital Cooperative and by Maggie Cohn from Cooperative Fund of the Northeast. So we're really excited to have them here today and to dive into some conversations about finances. Before we get going, I want to just introduce myself. My name is Faye Mack. I'm the Executive Director here at Food Co-op Initiative. And if you're new to FCI, we have a lot of folks signing up this year who are just getting started, which is really great. So if you're new to FCI, we are a national nonprofit organization that are wholly committed to all of you. We are here to help people who are trying to start food co-ops in their own community. And we have a number of resources and guidebooks available. We host educational formats and presentations like FCI Live, and we also co-host the only in-person national conference dedicated to startup food cooperators, the Up and Coming Conference. Please check us out as well. All right, so as a reminder, please feel free to introduce yourself in the chat. If you're just joining us, please feel free to ask any questions in the chat, and we'll also have ample time for asking questions verbally as well. And finally, oopsies, sorry about that. I'm going to stop sharing my screen and get going. All right, thanks so much.
All right, thank you, Faye. I'm Mark Fick here. I'm with the Shared Capital Cooperative, the senior loan officer there. I'm going to be hopefully sharing my screen with everyone. And hopefully that looks like the first slide of the PowerPoint deck. We're here to talk about the role of a loan in your capital stack. Hopefully that's what you're here for as well. As I said, I'm Mark Fick with Shared Capital Cooperative. I'll talk a little bit more about who we are in a second here, but would want to just acknowledge that we're here with our lending partner, Cooperative Fund of the Northeast, working out of the Northeast part of the country, and happy to share our stories, our experiences. Both of our organizations have worked for many years with grocery cooperatives on various parts of the country, and want this presentation to be informal and conversational as much as possible. So we welcome your questions throughout, and we will have time at the end for sort of deep dive into some issues if people want to do that as well. We've got a handful of slides here that we're going to go through, but we don't need to dwell on that. If there are topics that are related to what we're talking about that you want to follow for a bit, we're happy to do that as well. So I want to keep this open and like I said, open and conversational as much as we can. Let's see, I'll let you, yeah, sorry, Maggie, yeah, go ahead.
I was just going to toss in that if people have clarifying questions as we go through the slides, please just interrupt us and ask your questions, because we don't want to go through these and not have people sort of understand what we're putting out.
Yeah, thank you. Excellent. Let's see. So we'll talk a little bit about ourselves, and then we'll spend our time really talking about the topic at hand. So again, Mark at Shared Capital. Shared Capital is a democratically owned fund, as our name implies. We are a cooperative. We are owned by the businesses that borrow from us and the businesses that invest in us. And what makes us even more unique in the lending space is that we only work with cooperatives. So we are co-ops investing in co-ops all across the United States. As you can see, we've got more than 300 members. We've got we're a relatively modest size fund with about 24, I think we're up to $25 million in assets. But we do work across the country, and we work with all different kinds of cooperatives, meaning housing co-ops, consumer-owned grocery stores, farmer-owned producer co-ops, worker-owned businesses of all kinds. But grocery store cooperatives have always been a core part of our business and a core part of our membership. And look forward to talking with you today about how we make that happen. I'm here with my coworker, Roderick, if you want to take a minute and introduce yourself as well.
Yeah, hi everybody, I'm Roderick McCulloch. I'm a loan officer with Shared Capital Cooperative, and my background is in food co-ops. I spent about a decade working at Seward Community Co-op here in Minneapolis, in a ton of different roles, but finishing my time there as the merchandising coordinator for all of the fresh departments before starting and taking on this role at Shared Capital. I'm happy to be here and thanks for attending. I'll pass it. Do you want to?
Yeah, Maggie, why don't you tell us a little bit about yourself and CFNE?
Sure. I think in many ways, Shared Capital and CFNE have followed the same historic path. CFNE was founded as the Cooperative Fund of New England in 1975, specifically to lend to food co-ops that wanted to shift from a purchasing club or a buyer's club to bricks and mortar stores and could not get loans from traditional lenders. So we now also lend across the co-op sector. We do also lend only to cooperatives, housing co-ops, worker co-ops, food co-ops, ag co-ops, artist co-ops. And we are now a loan of, I think, just over $50 million. So a little bit ahead of Shared Capital. And we disperse money only in the Northeast, so the 6 New England states and New York State. We have 5 loan officers scattered across the region. So everyone is more or less geographically close to everyone in their borrower portfolio. We have, if you want to play around with this is an interactive map. It's on our website. So you can go in and see what each of those dots represents and in your new see how up to date it is.
Great. Thank you, Maggie. So we're here to talk about money and specifically talk about debt. You know, of course, you all know there are different kinds of money that you are trying to pull together as you think about launching your business, your grocery store. And those different kinds of money are going to come from different places. And again, our primary topic today is loans and debt for your business, but we want to talk a little bit about kind of the broader picture of all the kinds of money that co-ops are using, or typically are using, and where debt fits within that spectrum, so to speak. If we think of equity on the left-hand side and debt on the right side as this sort of spectrum of capital that we turn to, debt can be senior regulated loans, they can be subordinated loans, they can be loans from different sources. But so even just within the category of debt, we have different subcategories of ways that might come in. And we have preferred stock, meaning investors coming into your cooperative that are paid out only from the profits and the revenue of the business. You have common stock from your members, and you have grants and donations. And I know you spent some time earlier today talking about a lot of stuff coming out of that category. But I think we want to kind of unpack a little bit just to clarify, make sure we're all on the same page of what we mean when we talk about equity types or when you talk about debt types. Again, primarily the role that a group like CFNE and Shared Capital plays for grocery stores is typically as a debt provider. Now I know that each of us have different ways in which we work with some equity products in different circumstances, and that's something that can be explored at times for different cooperatives. But primarily, the role that we're playing is as a debt provider and bringing various kinds of loans to the structure itself. So if we have that as the background, and want to spend a little bit more time on this page and ask for input from Maggie and other folks here. When we think about where does this money come from, we start to look at a lot of different opportunities, a lot of different options, some of which may be available to most folks, some of which are very specific. But here today, again, we're primarily going to be focusing on the role of those right to rows, which are often going to come from CDFI, mission-based loan funds like ourselves, might come from more regulated banks or credit unions, might come from impact investors or foundations or public programs. And each of those plays out in different ways in your capital stack. I'll pause here for a moment and ask Maggie to offer some thoughts here.
Well, one thing that I have seen is that what kind of money your co-op can access can be dependent on where you're located. Primarily sort of the community in which you're located in. Some municipalities will support the development of food co-ops. but probably not all. Co-ops in low-income communities can often access grant income much more easily than co-ops in wealthier communities, whereas co-ops that don't meet certain HUD or CDFI income eligibility requirements are not able to access grant funding, but are perhaps better able to access member loans and member donations. So that's going to make for some difference in terms of the way a food co-op can actually put together its capital stack. I think we also, and we'll get into this, I think more in a minute, if I'm right, Mark, as developing a co-op has gotten much more expensive over time, the amount of money that comes from different aspects of financing has shifted. So a loan, we might make a loan to a food co-op that is essentially the same amount as a loan that we would have made 10 years ago, but it's a much smaller percentage of the overall amount of financing that's needed. And as a result, we've seen a lot of food co-ops get pretty creative about how they bring money into their projects.
Yeah, and I think another thing to kind of highlight here is that you might be thinking of a loan, but you aren't necessarily always going to find that loan from a loan fund per se. In that most any kind of investor construct impact investors, foundations, and other cooperatives can structure their investment into your cooperative in a variety of ways. And that depends on your relationship. It depends on their ability to put their money at risk, how long it can be out there, those kinds of things. But we have examples of cooperatives investing directly into cooperatives with debt. We have examples of cooperatives investing directly into other cooperatives as equity investors, and also as guarantors for debt. And so when you think about which box you're pulling or which bubble you're pulling your money from, and we'll keep talking about this in some other slides too, is it's important to remember that you want to kind of figure out what the possibilities are from that particular source of funds, and maybe go in with thinking about different ways that you might make that request. Do they have the possibility to think about equity? Do they have the possibility to think about other softer debt or subordinate debt rather than a typical senior loan that would come from a more regulated institution? And I think within that is sort of what we want to talk about is what are the expectations of the lenders and what are they looking for, and what are your needs, and how do we really match that up? Because this is about building a relationship at the end of the day. And so, yeah, so when we think about, those sources of financing, most of those have been in those columns for many years. We've seen some changes in the sense of foundations are a little bit more interested in the last decade in creative investment in different places, or at least investing in capital infrastructure for co-ops, whereas in the past, they may have been less interested in that. And other sources have been, from the public side, have been changing shape and making themselves available in different ways. But a lot of it has to do with how it's being structured at the end of the day. And like Maggie was saying, debt has become a smaller portion of the total project sources for most grocery stores. And part of that is due to lenders and debt providers being a little bit more cautious in a challenging industry. And some of that is due to just the fact, like Maggie said, that the total costs are bigger than they have been in the past, and debt isn't able to increase along with that. And so we're seeing, how do we fill in that giant and growing gap with these other sources?
Yeah, and I would just add there that when I talk to applicants or potential borrowers of shared capital, I really emphasize that we're here to see co-ops be successful. And a big part of that is figuring out what is the right type of financing for a startup co-op. Debt is going to be a piece of it, likely, but we really want to ensure that the co-op is taking on the right amount. So I really encourage people to be intentional about the percentage of their capital stack that is debt. Yeah, I don't love to see it used as sort of a fill gap. You know, if you figure you can get this much in equity and this much in grants, but you still need X amount, don't just assume that should be debt. You really want to figure out what's the amount of debt that you can afford based on a conservative look at your financial projections.
Maggie?
Well, I would also say increasingly you see CDFIs offering a certain amount of technical assistance and loan readiness preparation as applications come in. CFNE has over the last 4 years developed a whole what we call our learning team that offers TA. We never used to do that. We would refer applicants out to other organizations for TA, but increasingly we have found that there are needs for people to understand their finances, to be able to produce a really reliable cash flow projection that would look at exactly what Roderick and Mark are talking about is how do all these different pieces of financing fit together? How much senior debt can your co-op manageably carry? And then aim for that amount. Don't, as Roderick says, don't just come in for $1 million because you think you need $1 million. If you can repay a loan of $1 million, that's great. But otherwise figure out how much debt you can repay. And then, you know, FCI, I'm sure, has resources to help co-ops figure out other aspects of funding. Increasingly, I think all of us as lenders have partners and access to resources to help figure out other ways to bring money into a deal that is more flexible and perhaps more accessible, or maybe not more accessible, but easier to work with over time.
Yeah. I want to call out, we mentioned 2 federal programs that have been used. Well, New Markets tax credits have been used to varying degrees, mostly on expansions historically or growth, but now sometimes on newer grocery store development, and SBA backed loans, which are a relatively new application in the cooperative world. Just to sort of highlight that those are sources that are maybe used more commonly now, and or if, to the degree that we're still exploring and practicing and figuring out when is the best time to tap those federal programs. But I think it is an indicator that the sources and uses and the development projects and the development budgets are getting more complex. As well. As we add more layers, there's more complexity to the relationship between each of the sources of financing, the claims on lien, the claims on debt service, how who's prioritized in what circumstances, how well do they work together with each other. And I think those things are worth exploring, really depending on the size of your store, whether you already have a fairly complex sources and uses, and whether you can kind of fit into the structure that those federal programs require. And sometimes something like New Markets tax credit causes more headaches and expenses for using the program than it might be worth to a smaller store. So worth exploring and working with your development consultants to figure out, does that apply or not? And often it's not going to, but it's worth, it can apply enough to make sure that you ask those questions early on.
I would also add that sometimes food co-ops can qualify for USDA grants or USDA loans. That depends. I know nothing about this, real. That's all I know. Co-ops can apply, can sometimes qualify. I think it depends on where you're located and to what extent you're supporting local agriculture. But it's and it's federal money, so it's a complicated application process. But it's definitely there, and the CDFI fund, from which I'm pretty sure Shared Capital and I know CFNE periodically get money, has funding specifically for healthy food financing. And there are some states, I know Pennsylvania and Massachusetts, I don't know who else, have funds within the state budget specifically for supporting healthy food initiatives. In Mass, it's called I think in Pennsylvania, it's the Food Trust, the Massachusetts Food Trust. So I don't know if that's, but there are other things to look at as you sort of, as you know, sort of nose your way around your city and state budgets and see where there might be funding available.
Mhm. And for many of those types of programs, sometimes you are working directly with the USDA for a certain program. For something like HFFI, you are mostly working with a local CDFI, a local community lender, mission-based lender that is kind of utilizing those dollars to pass that resource through to you. And so there are advantages and disadvantages to those different kinds of relationships. So yeah, again, often again, it's coming back to kind of understanding these sources of money, and some of this is understanding. It's like, why is it frustrating in this circumstance for this entity to provide a loan, but it's so easy for another entity? And a lot of that has to do with what kind of an institution are you working with? Are they a regulated or not regulated institution? Are they a nonprofit or a for-profit? Are they community-based or national or international? And all of those elements of who they are going to be kind of winnowed down into ultimately their willingness to take a risk on your project and your business and your cooperative. And so I think it's also helpful to understand to sort of understand the identity of who you're going to and who you're asking for the funding from, so that you don't end up kind of banging your head against a brick wall and trying to change an institution that can't change on some level. And maybe there's a different kind of resource and making sure you're talking to the right people who understand where you're at. So you know, like the CF&E and Shared Capital and LEAF and National Cooperative Bank and the other active lenders in this space who are mission-based are going to be a lot easier to figure out how to pull this together with than some others. And so it can be frustrating at times if your local resources don't align up with what you need. But there can be national and regional lenders and resources you can turn to as well.
And likewise, as Mark indicated, you know, trying to shift what you're asking for to meet the lender is not ideal. Similarly, you don't want to shift your priorities or your mission. We don't want to see mission creep from a co-op that's just getting started to try to fit into the bucket of a certain lending institution. So really think about it as a long-term partnership. If you're going to get debt financing from a lender, you're going to have a relationship with them for a number of years. You want to make sure it's somebody that you have similar values with and that you could see yourself working in a relationship with them for that duration.
There's a bunch of stuff to dig into on this slide. And I want to preface it with, you know, I think often you hear about the C's of credit, which are kind of shorthand in the world of lending and investing, really, in our modern economy, for what investors and lenders are using to assess, again, coming back to that risk analysis, really, it's like, what is the likelihood of us getting our loan paid back over time eventually? And that if your only perspective is a risk perspective, then you are going to be focused almost exclusively on those C's. But for a lot of what you all are building for your communities and for your cooperatives is more than just an economic activity. It's got a lot of other elements to it around community building and democracy and leadership and equity and justice, and you're building something that is more than a business. And so when we do our underwriting and we are trying to measure our analysis of risk, there is those classic kind of business plan elements of cash flow and collateral and capacity and character and conditions. But we also want to unpack what does it mean to be an owner of this cooperative? What does the governance structure look like? Is it truly democratic and transparent? How does patronage work, and what are the benefits to being a member and the responsibilities? How does your cooperative engage and model its business around equity and justice in this day and age? And so those, of course, aren't directly about a lender trying to figure out if it's going to get its money back. But for most of the lenders that you're going to be working with in this space, those elements are important as well. and sometimes equally or even more important for our willingness to take a risk along with the project that you are proposing and developing.
So I would say when you look at the 5 Cs, what we do, what CDFIs do, and are doing even more now than they used to, I think, is leaning more and the borrower, and the ability to repay is based on your business plan and your financial projections, but not so much on whether or not you can provide collateral. And if you are a strong co-op and you have mission match with your lender, we are going to be less worried about, do you have the collateral? I mean, what is the value of your freezer cases versus the value of the loan? It's not that we won't put it down as collateral, but it's I think, Mark, you would agree, maybe less and less of an important issue in making loans to co-ops.
Yeah, I think there are times when it makes it easier to make a larger loan, and can help to strengthen certain elements of the structure and make the structure easier to put together. But it's definitely not a primary requirement for most of our lending. Yeah, I think, and maybe we can touch a little bit, although I think I have some duplication on another slide, but thinking about, what are our expectations? So I'll come back to that in another slide. Our expectations around this business plan and what you're bringing to us and where you are in the process of development. Just want to call out that you don't have to have everything figured out the day you call us up and say, hey, we're looking around for financing. We are happy to take calls, and I know this is true for CFNE and for us, happy to take calls early on. And in fact, we appreciate taking calls earlier than later, so we're not dealing with a scramble situation, so that we have a chance to sort of get to know a project over time, and as it spends its time through development, and check in from time to time, and sort of learn some of the character of the cooperative as you work through your development process. And that helps us to build confidence in you as an organization and a group and a collective of people building this business together. And so we understand that development budgets are living documents, and they change over time and evolve based on what the opportunities arise and or disappear, as is sometimes the case. And so getting back to that relationship thing, it's helpful to be transparent in our communication from both sides, so that we can be upfront about where we see challenges, and you can be upfront about what you need and what you're looking for in your financing.
I was going to
say. So, yeah, sorry. Go.
I was just going to say, we often when we look at it, we look at a 6th C, which is communication, sort of both within the between the board and the members, and between the co-op and the lender.
Yeah.
That's the issue of transparency and openness.
So what are our expectations, and maybe they've changed a little bit over time? We already talked about collateral, so that's there are times when we do need to see something for collateral, and there are times when we have some flexibility around it. But again, it's not an exclusive requirement for most of our lending, and we're other kinds of liens as well. And I think there is an important question to bring up here as you think about how you're putting your stack of capital together, is who has claims on what. Everybody's going to have some kind of claim on something for the most part. But if the various lenders, if you have more than one, are going to have to be put into an order themselves. If things get tight and people need to work through challenging situations, how do those lenders work through that process together with you as a cooperative? It's important to understand what happens at the maturity of your loan or how your loan is structured and phased. So it is common that for a startup grocery store, we're putting together financing packages where the amortization of the loan is longer than the term of the loan, which means that you're paying on a loan that is set up to be fully paid over 7 or 8 or 10 years, but the loan matures in 3 or 4 or 5 years. And that's very intentional for a few different reasons. One is that we assume that things are going to look different than they do today, 5 years from now, and that often 5 years into a store, you have a sense of what direction the store is going. And that can become an opportunity to restructure that debt, restructure your capital a little bit. And if things are going really well, then you can restructure it to your benefit and maybe reduce some of that debt at that point, or re-amortize it out in different ways. If you are in a challenged situation, well, that's a firm stopping point to say, hey, let's see what we can do to reset these phases and the payment structures so that we can match the conditions that the cooperative is actually seeing. So it's important to think about, how quickly are you paying off this debt? And when the loan matures, is it fully paid off or not? And if not, what's the plan and what might that look like going forward? Maggie or Roderick, any thoughts?
The only thing I would add, and this goes back to your previous comment about open communication and transparency, is that if you have a loan that terms out after 5 years, even if it's amortized over a longer period of time, during that period of time, we find it really important, and we think it's important to you, to learn about any problems that are coming up as they occur, because we are certainly very open to amending a loan even within that initial period of time. So that if we've structured a loan that everybody thinks will work and it turns out we're wrong, give us all the opportunity to do a restructure before things get too far down the road,
Yeah, indeed. I mentioned some of these loan phases at the bottom of the slide. It is very typical that during the first year or more of your loan, you might, you're going to have tight cash flow as your store is getting established and off the ground and building its revenue and its customer base. The assumption is that for a while you're going to be losing money. And so part of your capital stack uses, of course, we want to know that you've got enough working capital, enough cash on hand to keep the lights on as you establish your business over that initial startup phase. But part of what we can often do as lenders is keep your debt payments lower during that same phase to give you a little more breathing room with your cash. And so we often look at an interest-only phase during that kind of stabilization period or startup phase of the loan and the business. So you're paying maybe half of what you would normally be paying on that loan. That's the upside. The downside is you're not actually paying the loan back yet. And so there is some give and take there. And so that's part of that conversation, working with your underwriter, your loan officer, and figuring out what is a realistic expectation for when this store will start to cash flow positively. Historically, looking way back, it wouldn't take that long, but it has become a longer and longer runway for independent grocery stores to get to that point. And so making sure that you and your lender understand, is this going to be a 12-month or an 18 or a 24-month process before we can really say, hey, okay, this store is on its own feet now, and we can really start chipping away at that debt.
And we got a question in here to your comment, Maggie, about starting a relationship early. The question is, how early is too early in terms of FCI development stages? Are we looking at 2A, 2B earlier?
Okay, I don't speak the language of FCI stages, but I would say I have started having conversations with groups that were just transitioning from buyers clubs to recruiting members, and way before they're even looking for space. And it's just, you know, it may be a conversation once a year, just to check in. It helps me to get a sense of their progress. It helps them, I think, to better understand sort of what's coming down the road in terms of when they might need financing and what type of financing that they need. We have also made sort of, I guess, what you could call a pre-development loan. Mark, do you do that too? Where we'll make a loan,
Sure.
we'll make a loan, and it's not a big loan, but to the co-op as it's recruiting members, as it's starting to get into the looking for space phase, because they may have a project manager that they need to pay. They may have an architect that they start to pay, and we can help them cover some of those costs. And again, it may be an interest-only loan at the early stages, but the sooner I know that somebody's out there working on something like forming a food co-op, and the sooner we start to build that relationship, I think the more information everybody has, and I think that's always a good thing.
Yeah, I would absolutely echo what Maggie is saying. The earlier the better. Again, working with CDFIs is very different from working with a traditional lender. We don't necessarily expect you to come with everything complete, ready to go for your application. We start underwriting and you're out the door in a month. I prefer to have the longer, slow rolling relationship where we might be able to suggest other resources or other TA supports, technical assistance that you could rely on as you're going down the path of starting up a co-op. And I am happy to have quarterly, monthly calls with a group that's just trying to figure things out. So I'd rather be there early and be able to be a part of that process, building that relationship, than brought on with the co-op feeling like they've made all the decisions, and perhaps some of those might make it more challenging for them in the underwriting process.
Okay. Well, we have made it through the slides that we wanted to share. There's a lot of more stuff we can talk about and stuff we can dig into based on what questions people have and where you want to go. But I want to open it up a little bit now and or dig back into some things we brought up, and we can go back in the slide deck as well.
Yeah, so if anybody has any questions, if you feel comfortable either raising your hand or just unmuting yourself, and I'll try to keep track of a stack if there is one.
It's a quiet crowd.
I was gonna say, well, everyone's being shy. I have a question.
Go for it.
The SBA was a surprise to me because it was, so I guess because I come from the cooperative world, like not the food co-op world. So this is, you know, this is our fourth cooperative and being a food co-op. And it was my understanding that the SBA didn't lend to cooperatives. Is it because food co-ops have a particular designation?
No, it's oh, well, I'll just a few thoughts, and Maggie, please let us know too. So to be clear, there are, I think, 2 transactions so far where the SBA has backed a grocery store cooperative loan. So it's not necessarily a trend per se. I just want to acknowledge it's out there. Both of those transactions were with the National Cooperative Bank, and they were large dollar transactions. But they required some really unique things. So you're right in that the SBA requires personal guarantees on things, and that is the major hurdle typically for cooperatives borrowers is you can't have 1,000, 10,000 people sign personal guarantees for your grocery store. So the National Co-op Bank worked with the SBA to model a situation where essentially they create a separate pool of funds that also have to be raised and identified and are isolated in a guaranteed pool. and that pool of funds is tied to the SBA loan. And so they kind of indirectly create a form of guarantee that was enough to keep the SBA happy. I have not myself worked directly with one of these transactions. I've only sort of tangentially been involved, so I can't unpack a lot of the nuance and details of it. But it is a complicated process, and not something that we would necessarily easily turn to for a lot of our stores.
And then I had a follow-up question. So I'm in Houston, Texas, and this bastion of cooperatives in Houston. I'm being facetious. But our food co-op is actually part of a HUD Choice Neighborhood Grant.
Great.
And when we submitted it, they were like, they were so enthusiastic about the food co-op. They said if we submitted a traditional grocery store or a for-profit grocery store in the traditional model, they would have rejected it because they've had so low success rates with grocery stores in these choice neighborhood revitalization initiatives. But they felt good and tried to help us to the best of their ability, look for lenders. So I hadn't thought about tax credits. I hadn't thought about the ways in which you fund affordable housing, right?
Mhm.
As a source of funding for this grocery store, which currently is being incubated on a corner store that the Housing Authority purchased as they were applying for this choice neighborhood grant, right? And so now that's in its inventory of property. And so I guess I'm just curious, is there any projects that you've worked on that have been involved in a choice neighborhood or a HUD initiative? And I'm also wondering, because they have community, development dollars, which we don't really tap in Houston, right? We do housing, but we don't do a lot of economic development with those dollars. Typically we haven't. So I just wanted to know, do you have any experiences working with any of the funding or lending that's associated with HUD and those kind of ways they fund economic development to support housing and community development?
Maggie, do you have any experience with that? Yeah.
I really don't. I mean, we do not do SBA lending because of the requirement for personal guarantees. I mean, there was a legislation passed 2 years ago, I think, that mandated that the SBA lend to co-ops or provide guarantees for co-ops, but the SBA has refused to remove their requirement for personal guarantees. So that's been a super sticking point for us. So I don't know. I mean, the only other federal program that you might look at again would be USDA money.
Okay, yeah. Okay. And we work with
Yeah.
UT Ag Extension, so we could talk to them
Yeah.
about them. Yeah.
I mean,
Yeah.
USDA has a very strong history of lending to co-ops,
Mm-hmm.
mostly rural co-ops, but the Dorchester Food Co-op in Boston, which is in what I guess you could call like an inner city, certainly low income BIPOC neighborhood, has gotten money from USDA.
Okay. Okay.
Yeah, the only with as far as HUD goes, my experience is all on the housing side, so I haven't worked with them on their other programs.
Well, I'll
But I
say they
think
were
there are.
very encouraging, so I think
That's
that's a
great.
relationship to think
Yeah.
about. They really liked the idea a lot, and we did. I just want to say we also did a childcare co-op. Every business we developed were co-ops, and they were very curious and supportive of it. So maybe there's
That's
something
wonderful.
there. Yeah.
Yeah, that's wonderful. Yeah, go with it and let us know. Pave that road for us, and then tell all the other HUD offices about it.
Right.
All right, I saw Sheila had your hand up.
Hi there. Sorry for being late. What I wanted to know was, Maggie, you had, came right out of the gate and said that your your group works with predominantly the New England states. Mark and Roderick, are you guys all over the United States, or do you guys more focus on a particular, like just the Midwest, just the Southwest, that kind of thing? Or are you guys kind of all over the board?
Yeah, Shared Capital is a national CDFI. So yeah, we have borrowers across the country. If you go to our website, we have a map that has, pinpoints of all our different borrowers. But yeah, we can work in all 50 states.
Cool, thank you.
Any other questions?
Since there's so much silence, I just have one more question. So we have we have FCIs locally. Is there any way to help them, understand this model locally, to tap into local funds? I'm just wondering, I'm grateful, we just have so little infrastructure in the South. So I'm wondering, is there a way that we can help FCIs, see this as a potential, a source of lending for them? What's your thoughts on that, or should we just not bother?
What do you mean when you say FCIs?
I'm just saying, like, we have lender. I didn't mean FCIs. I'm sorry. I mean CDFIs.
Oh, okay.
Sorry, I was looking at Faye. That's why I keep my camera off. I'm easily distracted. But CDFIs, because I just wondered, like, should we just, not spend so much time trying to get our local lenders on board because it's too hard? Yeah. What are your thoughts about that?
It is at least worth reaching out to confirm, like, make sure you get that no, because who knows, there might have been a maybe in there somewhere. And part of it is that, yes, there are thousands of CDFIs across the country. They are all mission-based. They are mostly doing really good work. But a lot of them are focused, say, exclusively on affordable housing, or exclusively on traditional small business lending, or exclusively on infrastructure for community facilities. And so part of it is making sure that you're talking to a CDFI that even does general business lending. So that's kind of a subset. But then among the business lenders, there unfortunately are only a handful of us in the world of CDFIs that really engage at this level with cooperatives and really understand kind of the nuances of the structure. That isn't to say that those other CDFIs aren't welcome to start working in this space. But many of them this is a completely new arena to them, a new way of thinking about lending, and you may sometimes be able to pique their interest. And if that's the case, groups like CF&E and ourselves will often work side by side with a local or regional community lender, especially if it's their first 1 or 2 times working with a co-op, and we can kind of co-lend with them. They can sort of lean on us to sort of understand the co-op thing. We can lean on them because they're a local relationship, whereas we can't be everywhere at once. And so it's good to have a local relationship too. So there are definitely many circumstances where we're lending alongside other lenders, and sometimes those other lenders are just trying this out for the first time.
And I would say we can't lend along with another lender in Texas, but I think most of the people on my team are happy to talk to anybody at any point in time to sort of help them even consider or contemplate the possibility of lending to a cooperative. There are 2 sort of resources that you can look at. There's the Opportunity Finance Network, which is a trade association of CDFIs. And I'll be honest, I find their website a little difficult to navigate, but you can go there and find CDFIs in your area and start to reach out to people and see who might be interested in even learning about financing a co-op if it's not something that they do now. And the other is that they're not all, but there are some credit unions that will also do small business lending. And it might be worth looking to see if there are credit unions in your area that can do that as well.
Yeah, like I said, the categories of CDFIs, credit unions, most credit unions are consumer credit unions, and they don't touch small business, but among the small business ones, it's good to pull them into the co-op world as best we can.
There's a CDFI, I don't know where they're based, called Pot Liquor Capital. They do lending to farmers in the South. They might know of lenders who would be interested in lending, for example, to black-led food co-ops in the South, because there's certainly an overlap there.
What was that name again?
Pot Liquor,
Pot Liquor, yeah.
P-O-T-L-I-K-K-E-R, Pot Liquor Capital.
And thank you. This was a wonderful conversation. Thank you.
What's your organization, Asada?
Our co-op is the Third Ward Food Co-op. But we have a Seed Commons, supported entity. And then my nonprofit, Sankofa Research Institute, is the one that kind of did the work and submitted the strategies to HUD. So we are just getting started here, but moving and have a lot of pieces if we can bring them together, even with the local government, right? So we have a partnership with the city, but they just don't know what to do. When they don't know what to do, they make it very hard. So just this has been helpful to maybe find them some peers to help educate them on the model and, how to financially support the model.
Right. Right. Yeah, that's a steep learning curve for most municipalities, I've found.
Well, we got time.
They could look at Austin.
Does the city of Austin provide support to co-ops?
Yeah. So my organization, the Austin Cooperative Business Association, we have multiple contracts with the city to provide technical support, but I was referencing it specifically because they are giving $500,000 for like $300,000 is for the feasibility of a food cooperative, and then they have $200,000 if it seems feasible that we're looking to access within the next year. So I was like, yeah, Austin and Houston ain't that far from each other, so
It's true.
Houston doesn't have to look that far to see like how a city can be supportive. Not that like not that Austin is like perfect in their support, but like there's something.
There's something, yeah.
I know you guys said this, but I guess I'm going to ask you a question only to stress it. I think a lot of startups come to me and say, I tell them to go talk to the lenders and start getting into relationship. And they're like, we don't know enough yet. And what they mean is they're afraid to talk about their pro forma. They do not understand it as well as you. Can you just talk a little bit about, if they call you up, what they can expect from that conversation, to just put folks at ease? Because we've all talked to lenders at some point in our lives, and it is nothing like talking to a CDFI. And I'm just wondering if you can share a little bit about that.
Well, maybe just a few thoughts. So, when people call us up for the first time, I'm not usually spending very much time with numbers.
Right.
I'm usually spending time trying to get to know what's the vision of this group, who are they, what are they trying to accomplish, what might that look like, what's kind of the scope and scale of this thing. So I think it's more about, if you're making that first call, is just being sort of familiar with yourself and your group and have some familiarity with what you're trying to do, because we can share spreadsheets and get into the numbers later. I might ask, kind of generally speaking, do you think you're looking for $20,000 or $2 million? And hopefully you have some sense in that range of where you fit. But we aren't expecting any too many details at the beginning.
But I will say, once someone has started to work on the numbers, I have found it really helpful to see the categories that they're looking at, and to be able to say, when you're ready to submit an application, these are the things that we need to see pulled out. This is, and I often will, suggest that people do one of our workshops or somebody else's workshop just on financial literacy, because I never thought I would say this in my life, but I cannot underscore enough the importance of really understanding your profit and loss statement, your balance sheet, and your cash flow statement, and how they all work together. And once you've got that down, your ability to sort of fill those numbers in and make decisions based on those forms is hugely, hugely helpful. So I do like to have that conversation with people early on and get them the TA that they might need as early as possible, so that as things are being built out, it's being built out in a way that is most helpful to them, or to you actually, right? And then is most helpful to us when you do finally come in with a loan application and we're underwriting it.
Yeah, and I try to be really clear that financial literacy is not equally accessible and it's not easily attained, and that my goal is to help see co-ops be successful. So if there's anything that I'm saying that someone doesn't understand, I want to be slowed down. I want to make sure they have all the information they need, whether they choose to seek financing through shared capital or not. My goal is to get them the resources they need to be successful. And so in many cases, I'm responding after that initial call with just a list of different resources that might be helpful or supportive in their cause.
Great, thanks all. And I'll just say that there was a session earlier in this FCI Live around understanding your pro forma. So there are resources out there to help you begin to understand this and think about it. And with that, I'm going to remind us that for folks who do want to stay on, we can stay on for a few more minutes, but I'm going to wrap up the formal session by saying thank you so much to Maggie and Mark and Roderick for sharing your expertise today. This was a super informative conversation. Thank you to everyone for coming and for asking your questions and being part of this. In your chat is a link to our survey. It really does only take 1 minute. Please take that before you move on with your day. It really helps us as we plan future programming. I also just want to take a moment to thank our FCI Live sponsors. So as you know, FCI Live is free. And that's in thanks in large part to our many sponsors, including our 2 champion sponsors, Illuminate and National Co-op Grocers. So big thanks to them. And with that, thank you all for coming, and we'll wrap it up.
Everybody.